Okay, thank you everyone. My name is Gerardo Santos. Today we will be discussing managerial accounting. We will be discussing chapters 11 and chapter 12 for the module 6 discussion. Let's get started. Today we're going to be talking about using decentralized organizations to control operations, what that looks like, and why an organization would use this type of organizational structure. So first, what is a decentralized organization? Well, a decentralized organization is an organization that delegates decision-making and operation responsibilities to managers of each segment of the organization. Let me give you an example. I'm going to explain the differences between centralized and decentralized through the following image. For a centralized organization, you're going to have one manager. This person could be the CEO of the company. And then you'll have, the subordinates, the employees, the members of the team, okay? In this structure, that one person, in this case, the orange bubble for centralized organization, is going to have all the control, all the decision-making, and they're going to dictate whether or not activities are done, purchases are made, and really the end-to-end functionality of the organization. Now, this is a good structure if you're a small organization, a small business operating locally without much dependence on really a lot of decision making. However, this type of organizational structure is difficult to implement when you have a large organization. For example, a company like Procter & Gamble, who has multiple products, multiple organizations that fall under the one Procter & Gamble company. Now, I bring this up because in an organization like that, where there's multiple moving parts, multiple organizations under the one organizational name, you're going to need to allow other managers to make decisions so that you can make other decisions, right? So, for example, if you're the CEO of a Forbes 500 company, you're not going to be making the sales decision on the sales floor. Leave that to the sales manager. In a decentralized organization, this is what happens. Top management will provide lower level management, often known as local managers, will provide them with the ability and responsibilities to be able to make those decisions. Those decisions will come in the form of the local sales team, right? The manager might allow different techniques to be implemented, might make different purchases options or sales options depending on the needs of that specific situation. A decentralized organization allows the CEO, the president of the company, top management to steer clear away from those decisions so that they can focus on the bigger picture. So let's get into it a little bit deeper. Why is decentralization needed? Well, as I said a few moments ago, there are companies that can be global. They can, hold a large presence. In this case, let's call this Company A. Company A operates in about 5 different countries, right? You have Australia, Middle Asia, you have Europe, looks like Argentina, as well as the United States. An organization with a global presence like this is going to have a lot of small decisions that need to be made, right? You might have the CEO probably operating out of Europe, and then there might be, a local manager in Argentina needing assistance with maybe a sales activity. Well, in that scenario, because it's a global organization, a decentralized strategy will allow that local manager that lives in Argentina, knows the culture, knows the customer base, to be able to make that decision, whatever it may be, will make that decision to allow, for the sale of the product or whatever it was. It will help smooth things along and process whatever activities were needed to be done. And then the high level manager, right, the CEO, they would not have needed to deal with that because it was something that could have been handled by a local manager. So this is why it would be needed in the global presence. Now let's talk also about what it means when you have multiple products, right? When it comes to a need for decentralization in product teams, this is where you have a diverse product line. You might have something as simple as a bottle of water, That could be product A. So product for team A would be the bottle of water. Product for team B might be, a bottle of juice. Maybe it's apple juice that's being produced. And then product C would be Coke, right? You have a can of soda. You have different products. These three products, in a decentralized organization, you're going to have teams that duplicate, the functionality within their team, right? So here we have just an example of a distributed UX team. Now this image came from the Nielsen Group database, and what it's showing is that there's a UX member from the UX team on each product team. What this does, it allows for each product to work cohesively as a unit by themselves, making the decisions for their product internally without having to step out of their team and go to an external manager such as the president, CEO, etc., top management. They won't have to go to top management to make those decisions, right? So this is why decentralization can be useful in product expansion. Now, one more thing. Let's talk about the bigger picture. So running the entire company can become overwhelming as activity and volume increases. So what that means is, as you have more and more activity, decentralization is useful as it frees up those smaller managerial decisions from top management. So now local managers are going to be able to make the decisions at the local level. They will be able to, ensure that each team has the resources needed to make those decisions. That way, top management, such as, the chief officers and the vice presidents, right? The executive level, they can focus on running the organization. They can focus on making the strategic decisions for the goal and the orientation that the company is going to be headed in. So, as I say that, decentralizing operations have both advantages and disadvantages. When it comes to advantages, we have increased expertise, right? The team is going to know their product very well because they work already as a team. They make the decisions internally. They know what they have. If that's a sales team, they'll be able to sell it better. If it's a product team, they'll know how the product operates. So that is where increased expertise comes into play. Another advantage is quicker decisions. Because the local managers have the ability to make these decisions on their own, they don't have to go to top management. That allows to speed up the process. On the sales floor, right? Like, let's assume Best Buy. You have a sales manager on the floor, and then you have a team manager on the floor. If the team manager has the permission or the autonomy to be able to make the decisions on that floor for their department, then they can make sales decisions quicker and make companies, let me restate that, they can make customers happier. A great example could be, selling a laptop, right? Customer A comes in, they need a brand new laptop, and they know that they just can't afford the $500, laptop. So a local manager, being the team manager, he can come in, step in, he or she can come in and step in and provide an alternative as a solution. It may be as simple as dropping the price a few $50, right? It may be something different as recommending a different product line. It comes back to increased expertise, but it allows for quicker decision making rather than going to the sales manager who may not know the situation or may not know the product very well to be able to advise. The next thing would be allowing top management to refocus their responsibilities. What this means is that as the organization is growing, top management can focus on the bigger picture, focus on the direction of the company, rather than being on the sales floor, attending to the customer's needs for that specific laptop that I spoke in the previous example. And last but not least, it motivates local managers. This is an important one, and it's a great advantage because as the organization grows, it's going to have more and more. It's going to have more and more local managers that will be wanting and striving to reach that next level, to increase to the next step. And by providing them with the autonomy to make these decisions, they're already practicing for when they grow in their career. So let's talk about the disadvantages. Okay, so we have a few disadvantages here, one of which is duplication of services. If we go back, thinking to the last maybe 2 slides ago, I spoke about how having different teams will have a specific team member of like the UX team. They'll have the same function, just duplicated amongst multiple teams. The reason this is a disadvantage is that your costs incurred for having these smaller teams in other teams will just increase, right? So as you have multiple UX teams on each product, it duplicates the cost. It duplicates the same service. If there was one large UX team for the overall organization, that UX team will be able to handle, all of the organization's practices. Unfortunately, sometimes that's just not possible, and decentralization is where it allows for a smoother operation. The only issue here is that it's duplicating the service, which is an increase in costs. Let's also talk about conflict of interest. Conflict of interest basically it entices local managers to make decisions on their specific product. Okay, so a great example might be, product manager A would much rather purchase the direct materials from an outside source rather than producing it internally because it might be a few cents cheaper. Yeah, in this scenario, the manager is just focusing primarily on his overall performance for his team because that's what he's being evaluated on. In the scenario, it might be that product manager A could have gone to product manager B and grabbed the materials from internally from that person, but because it was a little bit more expensive, they went with an external route. So that's where conflict of interest comes in. It skews the local manager's decision making for a more performance based rather than what's best for the company. And then we have loss of control. Loss of control is where top management loses control of the decision making for the organization. And when I say loses the control of decision making, it basically implies that they're no longer making decisions on the sales floor. They're no longer, making decisions at that local level. And that could be dangerous if local managers are struggling to maintain the high quality expectation that customers expect to see. Now let's talk about the 3 types of cash flow activities. In these 3 types of cash flow activities, we see how cash moves throughout the organization, where it comes in and where it exits. So let's start with the first one, operating activities. Operating activities are cash flows that are related to the net income. These can include revenues and expenses. So, it's what are you bringing in and what are you taking out? It all revolves around operating expenses though. So everything that is done at the operations level, right? So these are stuff like, income such as like sales, sales of goods and services, products, interest received from the loans, maybe dividends that are received from investments that they have made. And then cash payments. Cash payments are the materials purchased, direct labor, payroll, interest paid, as well as income tax and other operating expenses. We can also talk about the investing activities. Investing activities are related to the non-current assets cash flow. Those are things such as like long-term investments, property, plant, equipment, and any type of loans that they may have issued out. The cash receipts for that can be sales of the long-term investments. Those are like bonds, stocks, etc. Sales of property, plant, and equipment, as well as collection of principal for loans made to other entities or organizations. Cash payments, where the company spends money or pushes money out of the organization, are purchases of long-term investments, right? They're purchasing bonds, stocks of other entities, not of their internal entity. They purchase property, plant, and equipment, right? They make loans, issue loans to other entities. That is where they are spending money and where money exits the organization. Then we have financing activities. Now, financing activities are cash flow related activities that relate directly to non-current liabilities and owner's equity. What are those? Those can be classified as, issuance of notes, issuance of bonds, issuance of common stock, stuff like that. And then for payments, you will see principals of loans, principal of bonds, repurchase of a common stock, as well as cash dividend. Now, with all that said, we have these three different types of activities. We have financing, investing, and operating activities. What are these useful for? That's a great question. Well, first, the purpose of these three cash flows is to provide managers with a comprehensive metric of the overall health of the company's cash flow. Now, when I say overall health, I'm not meaning like it's how the company is operating. What it is, it's a more filtered version of what is going on with cash flow to help identify where the money is being spent and where the money is coming in. This helps managers to understand how the company is performing and where they can make decisions to either cut back or increase on spending. This is very helpful for when a company needs to make a decision on perhaps expansion, or maybe it's introducing a new product line. Whatever the case may be, they follow these three cash flow activities to help get a better understanding of how the organization is working. So I have an example here with two companies. I have Dragon Video Games Company and Simple Cards Games Company. For these organizations, the numbers are in the millions. I'm going to read them as in thousands, but just note that they're in the millions. So for operating activities, we have 7,225 for Dragon Video Games. We then see an investments that in investments we spend 3,189,000, and we also see that for financial activities we have $4,961. Okay. Overall, we see a net change in cash flow of negative $925. What this means is Dragon Video Games Company is spending more in investments and financials than they are bringing in through their operations. This can technically be a showcase of poor performance if information is not provided that backs up that this is a good value, right? Typically, when you see negatives, it's not good, but perhaps maybe the company made a large investment into future property, plant, and equipment that can lead to potential gains in a future period. So this is why it's important to know the big picture, but here it gives you just an idea of how the business operated within the given term. So if we take a look at Simple Card Games Company, we have $5,750 in operating activities. Our investment activities are $2,184, and financial activities are $2,651. The overall net change in cash for Simple Card Games Company is $915 on the positive side. This is important because we can see that Simple Card Games Company was profitable for this term. It means that more cash came in and they had more activities, right? They have more options to perhaps make better decisions for next period. This is why the organization, this is why having a cash flow chart can help the organization and help managers make good decision making, because they are able to see where the cash flow is, how much money is in-house, how much cash they can actually spend for other investment opportunities or increase in operations activities. And at the end of the day, both companies, while one might have a negative, one might have a positive, this is just an example of how an organization can use cash flow to determine where they stand financially. Thank you.